How can you use a company's fundamentals to help you figure out if they're a fit for your portfolio? Fasten your seatbelts, folks. This is going to be a good one. The channel members spoke up and they wanted a video on the art of stock evaluation using, of course, fundamental analysis. Whether you're a beginner or an experienced investor, understanding these basics is key to making informed decisions. Fundamental analysis is all about figuring out the core value of a company via its financial statements. It is a mathematical investigation that can offer up not only clues of how a company is doing today, but can also provide you with some probabilities on how that company may fare tomorrow. We are going to be looking at some key metrics today, and honestly, there is not a single metric that will tell you if this is the right stock for you. It is very much like a jigsaw puzzle, and when you fit together the different metrics or pieces, you then get a more complete, bigger picture. If numbers scare you, do not worry, as we can always call on our good old buddy, Mr. Math. Join the conversation. Let us know in the comments your favorite metric when you are dealing up some due diligence on a new stock. Your participation is well appreciated. Don't forget to like and subscribe to stay up to date on future content. And a huge thank you for that click. If you have watched any of my deep dives, you are more than likely familiar of how I break the data down into, well, surface data, cash, returns, and debt. This is the way I deep dive, but not necessarily how I will approach a new stock when it comes to looking for something to add to my portfolio. The surface data can be absolutely fantastic to give you a good feel for if you should even invest any time in digging deeper. First off, depending on what you are looking for, the market cap can tell you a lot. If you are looking for a long-term blue chip investment, the higher the market cap, the better. $100 million market cap is usually not a blue chip company. The market cap alone does not tell you very much, but it frames the overall value of the company you are looking at, and that's kind of like working on the edges of that jigsaw puzzle. When it comes to the beta, that statistic gives you a feel for the overall volatility of the company. A beta of 1 means that the company is as volatile as the market average. Well, 1 is the market average. Above 1, it is more volatile, and below 1, it is, of course, less volatile. It is a 1-to-1 relationship, so a volatility of 2 means it is twice as volatile as the market average. Normally, for a long-term investment, this is not as important, but it can be huge for shorter-term investments, such as a stock you are hoping to swing trade. Earnings per share, or EPS, is simply how much money each share is making, and as a rule of thumb, this is a number you want to see positive. If it is in the negatives, it means the company is currently losing money. That is not always a deal breaker, but it absolutely is a call for more due diligence to find out why, and if it is just a short-term blip on their earnings record. Price to earnings ratio, or PE ratio, can be useful when you are comparing companies within the same sector. It is found by simply taking the current value of the stock and dividing it by the EPS, or of course earnings per share. Generally, a lower PE ratio tends to be an undervalued stock. A high PE ratio may often mean an overvalued stock, but it can also mean the company is growing fast, or the market's expecting them to grow faster, especially with, say, tech stocks, for example. Return on equity, or ROE, is one of my favorite metrics. It measures a company's ability to generate profits from the shareholders' investments. ROE is calculated as net income divided by shareholders' equity. A healthy ROE will more often than not indicate a good investment. Still, do your due diligence, as sometimes very high levels of debt can skew the ROE. A great example of this is Dollarama. They have an ROE of 436.42%, which is crazy good. But when you look at their debt to equity ratio, it is 1,109.9%, and that is absolutely skewing our ROE. When a company has a high debt to equity ratio, it means it has more debt relative to its equity. This high leverage can amplify profits relative to the equity. Thus, it skews your ROE calculation. I will almost always ignore a stock with a negative ROE. Moving beyond the surface data, I also like to dig into their cash situation. It is good to understand what is coming in and what is left after expenses. So I will look at the company's revenue and then their earnings. For the earnings, I am looking for positive numbers. I am also looking at the change in earnings in both the last 5 years as well as those projected for the next 5 years. When earnings have grown and are projected to continue growing, that is usually a very good indication of a company that is going to make profits for their shareholders. I also like to take a look at that profit margin, which is basically calculated by dividing the profit by the revenue. For example, if you use gross profit, it gives you the gross profit margin, or if you were to use, let's say, net profit, you would get the net profit margin. So there are different types of profit margins. This metric indicates what percentage of each dollar in revenue translates into, well, profit. I will also look at their free cash flow, which in a nutshell is what is left over once you take their operating cash flow and subtract their capital expenditures from it. In essence, it's the cash that a company can generate after laying out the money required to maintain or expand its business operations. It is an important measure because it indicates the efficiency of a company in generating cash and its ability to pursue opportunities that enhance shareholder value. I will also look at a company's fair value to get a general idea of whether a company may be overvalued or undervalued. It is an estimate of the price at which an asset could be bought or sold in a current transaction between willing parties. So if the current price is lower, then there is wiggle room to the upside. This is, however, a metric that does rely on more guesswork in the calculations. So I usually look at it, but I do take it with a grain of salt. So when it comes to returns, as a total return investor, I am more interested in the bigger picture. So the return on investment with the dividends added in for a total return, I want to know what I'm getting back. A passive income investor will, of course, focus more on that dividend yield. Looking at how a stock has grown and rewarded the investors in the past can be a good indication that they will continue to do so in, of course, the future. Past success is, of course, not always an indication of future success, so you do want to be looking at more than just the returns. You want to see that the other fundamentals back up the hypothesis of future growth. Finally, the debt situation is often a make or break set of metrics that can torpedo whether or not I invest in a company. I will first of all compare their total debt to their total equity to get that debt to equity ratio. It is an important metric that provides several insights into a company's financial health and operational strategy, particularly in terms of how it finances its operations and growth. It can indicate the extent to which a company is financing its operations through debt versus their own resources. A higher ratio means more debt financing, suggesting potential higher risk, whereas a lower ratio indicates reliance on equity. High debt levels can lead to significant interest expenses and can increase the risk of bankruptcy if the company becomes unable to meet its debt obligations. Companies with higher debt levels need to ensure they generate sufficient operational profits to cover those interest payments. I will also add that you do have to take into consideration the sector, as some sectors naturally have higher debt, such as the banking sector. So if it seems high, check other companies across that sector to see if it is high in comparison to them. I will also look at both the short-term and long-term assets versus their liabilities. Together, these metrics are great for understanding a company's financial health, liquidity, solvency, and of course, operational efficiency. Short-term assets and liabilities provide you with an idea of the company's current liquidity, so its ability to meet short-term obligations with those short-term assets. Long-term assets and liabilities, those provide insights into a company's overall solvency or its ability to meet their long-term obligations. A healthy balance of long-term assets against liabilities suggests a company is positioned to sustain operations over the long term, handle long-term debts as they come due, and invest in future growth. These are the metrics I use the most, and there are more metrics out there that can fine-tune the picture we have already created. However, with these metrics we have here, they are a great starting point for your due diligence, and they do paint a picture that, in my opinion, provides a very good overview of a company. Always keep in mind, I broke this down in more of a total return approach. If you are a passive income investor, then you may place a different emphasis on some of the fundamentals. If you are a short-term swing trader, you are probably more focused on, well, technical analysis. Hopefully this breakdown of the fundamentals I use provides to be helpful to you in your investing journey. Keep the learning going. Watch my video on ARC resources linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.